Welcome to the Passive Income Podcast. I am your host, Dividend Dave. And remember, the best job I never had was when companies started paying me to not work for them. My guest this evening is Dividend Daddy. Dividend Daddy, why don't you just give us a little bit of a brief introduction of yourself?
Hi, Dividend Dave. Thanks for having me. I think this may actually be my first podcast appearance as a guest. So this is a lot of fun. So I appreciate the opportunity. In terms of background, I've been an investor, broadly speaking, in real estate and stocks since I'd say for about somewhere between 20 25 years of my life. I'm in my mid 40s now. So that puts me back somewhere in my early to mid 20s when I started to invest. And when I got into investing, of course, it was time that's different today, a lot more challenging to get started. But I started with index funds. I knew enough about what I had read at the time, the wealthy barber type books that were popular in Canada, where I'm based. And I knew that mutual funds, for example, were bad, high management expense ratios, and they're really good for banks selling them to you, but really bad for you as an investor. So I knew that much. And so I started investing early in index funds and just automated it, put money in regularly, whatever the weekly or monthly, whatever it was at the time. I can't recall. And that's how I got started. And then slowly over time moved to the dividend side. And I would say right now I'm a hybrid. I'm both ETF and dividend investor.
Awesome. Yes. The Wealthy Barber. That is probably the very first investing book I ever read as well, way back in the probably early 90s. So, again, we're similar age group. We're both based in Canada, which I think will lead to a great discussion because I'm sure we probably own or have on our watch lists a lot of very similar stocks. I also kind of have a similar background story of in my even late teens or early 20s where I was actually putting that 50 or $75 a month into a mutual fund. And unfortunately, somewhere along the way in my mid to late 20s, it was like, I need that money and cashed it out. And I obviously, today, 30 years later, I'm kicking my butt for doing so, but it is what it is. With that said, let's kind of get into some of the different sectors in dividend investing. And sort of the one I always start with is REITs, and that is because I love REITs. I just can't get enough of them. you know, um, Basically, my favorite is Ryokan. I'm sure you have an opinion of Ryokan, so why don't you share that with us?
Yeah, I hold Ryokan myself. About over 800 shares, anyways, in Ryokan. So I'm definitely a sizable shareholder. I do like REITs. Like I said, I'm hybrid in many senses of the word. I hold real estate, like physical real estate. I own my own house, of course, but also rental properties in Canada, but also in outside of Canada,
Oh,
and
wow.
even yeah, that the outside of Canada is relatively new. It's I've spoken about it on my blog at dividenddaddy.ca, and that property is in Mexico. But beyond that, I also hold through platforms like Addy and Willow real estate across Canada, because they've fractionalized it and made it much more accessible to invest in commercial properties that you and I couldn't afford to invest in
Right.
otherwise. The old school way, they made it much more easier. So I own at least parts of different commercial or mixed use properties across Canada. I'm waiting for the opportunity for some of these Canadian platforms to give access to Canadians to fractionalized real estate ownership in the US would be great. Just given that market, I can't access easily myself in terms of the new ways of investing in real estate. But REITs, yeah, RealCan for sure. and I hold investments in a whole whack of different REITs. I'm always thinking maybe I'm a little bit overly diversified and not concentrated enough, or making concentrated bets enough. But I am definitely a REIT investor as well, Dave.
Awesome. Yeah. So I'm not even sure where I'm at with RioCan. I'm somewhere between 240, 280 shares. I'd have to look at my phone to tell you to tell you where I am. But yeah, obviously, every month, nice one that comes in a week earlier than that mid month that payout of most of the dividends, and you're like, hey, nice, thank you, RioCan, for paying me to not work for you.
Yeah, the monthly ones are nice, just to see them land in the account on a monthly basis, which I don't know if all REITs do that, but it seems to be the case that many REITs, if not all
The
of them.
majority, I would say, I obviously don't quote me on this, but I would say at least 99% of them, just because REITs are based on, monthly leases, like leases that are paid monthly, or rentals that are paid monthly. So of course they're generating income monthly. They pay that out to the investors monthly.
Yeah, it seems to be the case. So for most, if not all of them, so that's always nice in terms of a regular income stream. And as I'm approaching myself, anyways, closer to like I'm financially independent, but approaching closer for myself, anyways, the decision about when I pull the plug and how I pull the plug, probably leaning more towards the work optional in a early retirement scenario.
Yeah,
The
when you say pull
reason
the plug, you mean you're talking about pulling the plug on that whole 9 to 5 work life.
Yeah, and still being work optional in the sense that if there's some consulting or something else, be it online or otherwise, that interests me and earns income, even better in terms of that sequence of return risk, diluting it. But the REITs, in that sense, providing monthly income, if not from a sort of empirical point of view, just the mental, emotional point of view, it's nice to see them appear in your account on a monthly basis. I mean, they could collect them and distribute them quarterly, and you still end up with the same amount of money, but it's nice emotionally, if
Yeah.
I could put it that way, to see them on a monthly basis.
Well, and every month it gives you something to reinvest, if you're, obviously most of us are like dripping that back into whatever else, right?
Yeah, totally. I'm a drip fan. I paused it recently as I was building up a cash bucket for potential early retirement. But given this, barring the last 2 days or last few days, anyways, well, last two trading days in October, and the market going back up, which is always nice to see it in the green. September, as you know, Dave, usually a down month historically.
Yep.
And I was taking some of that money that I would otherwise build for a cash bucket, and just investing it, because there's just the yields are too good on too many solid dividend paying companies, particularly in Canada, the BCEs, the Enbridges, the banks, et cetera, were down. Some of them below their 52-week low. So the opportunity was too good, and I
You were
diverted.
buying everything on sale.
Yeah, and sometimes I think I'm guilty of trying to do everything all at once. Sometimes I catch myself, but
We all are.
yeah, I'm an investor at heart, and I think it's going to be hard for me in the next couple of years to sort of turn away from that mode of always wanting to invest and reinvest. I'm struggling a bit with that, if I can be honest with you, Dave, in terms of I'm in that limbo period where I'm not retired, but I'm getting close to being. I could probably do it now, but
Right.
I'm getting close to making some pretty substantive changes, and yet I'm still finding it hard to build a cash bucket. Why? Because I'm reinvesting it, because October was
Yeah.
just the yields were too good on not just on crazy stocks, but on solid stocks that you and I would buy regularly anyways.
Right.
So why wouldn't I? I just find it very hard. It was too compelling. Too
Yeah, you're
compelling.
dollar cost averaging, and when you're looking at it going, "Oh, wow, I'm dollar cost averaging way down on so many of these," is like, how it's hard to resist.
Yeah,
That's what you're saying.
I find sales hard to resist. I don't buy a lot of things otherwise commercially in my life, like day to day beyond food and some entertainment here or there. I'm not a big purchaser of things I don't need. But the one thing I do like to purchase, and I do it very regularly if you follow my Twitter feed, I am constantly buying almost every day, not every day, but definitely weekly for sure.
Right. So just going back, the term work optional, absolutely love that. I don't know if I have ever heard that before, but work optional is perfect, right? Like that's where we all want to be, where we could get to that point of saying, you know what, I can take this contract or this consulting job on and work, and it's my option to work. It's not them. It's not life forcing me to work. It's I'm opting to work to just make a bit more money and have something to do for 3 days out of the week, or 10 or 15 days out of a month.
Yeah, absolutely. I'm currently, planning. I haven't done it yet, but planning to go part time in terms of 4 days a week. That's still on my radar. Just doing a last sort of checks and balances here before I do that. But that reduces my amount of sort of 9 to 5, if I can call it that. It's much more than 9 to 5 sometimes, but
Yep.
for argument's sake, 9 to 5. But work optional excites me because there are things I enjoy doing. I enjoy doing my blog. I enjoy doing the social media, Twitter, and I just started Instagram, so I'm dipping into that with my Dividend Daddy handle. So some of that stuff I really enjoy, and I want to continue doing it. And frankly, if I had more time to invest in it, I think I might be able to derive more revenue from it, given the small amount of revenue I make from my blog and social media to date.
Yeah, so I did check out your blog briefly. I think it was this morning when I was having coffee, and impressive. You had posted, I think you had about $3,400 in passive income just from dividends in September. Was that correct, or was that August?
It could have been. I'd have to check. But yeah, I'm averaging somewhere, if you're averaging it out this year, somewhere around, it's close to $5,000 a month on average, roughly. Don't quote me on the exact number, but it's around that. So some
So that
months,
would include your rental propities though as well. Your dividends alone are somewhere in that
no, just
34.
dividends, just
Oh,
dividends.
really? Just dividends are up to 5.
It's shy of 5, but it's getting close to 5 on average. So some months obviously are higher. Some
Wow.
months reach into the 7,000 figures
Yeah,
figure.
because quarterly dividends are every 3 months kind of bump that up for you, which is a nice little bonus, right?
Yeah, I just did it. I haven't sent the tweet out. It's scheduled, but I ran the. I'm going to pull it up just so I can be exact. But the scheduled tweet I'll send is I did a quarterly analysis from Q3 2021 to Q3 2022. Obviously, we just finished the third quarter
Yep.
of this year. My dividend increase is almost 40% dividend increase from 2021 third quarter to 2022 third quarter. So comparing those two Q3s, it's almost a 40% increase in dividends from about 10 grand to about 14, just over 14 grand
Wow.
during that quarter. So that's, for me personally, exciting to see that growth. I do invest a lot of money historically. I'm in a nice position where I earn a solid, decent income, so I'm thankful for that.
Right.
And I don't care about the Joneses. They're lovely people, but I don't spend my time worrying about what they're buying and keeping up with them. So I keep my expenses low, and the surplus of that money, obviously taking out of, you're buying food, and my house is paid off in full. So I really take the opportunity to invest a lot of money because, frankly, I have everything I want. I don't even know my mother. Maybe I'm telling you too much, Dave, but my mother at Christmas, it's coming, and she'll ask me, what do you want for Christmas? Of course, my mother's going to buy her son something for Christmas.
Yeah.
And I tell my mom every year, I've got everything I need. So she gets me socks and underwear, which is great. So I don't have to go out and get it. But beyond that, I've got really everything I need. So she buys me those little things, socks, underwear. She might get me a gift card or some cash, which is useful. So I can use it to buy some coffees here or there because I do like to go to cafes and work.
Yep.
So yeah, I guess I'm in a bit of a fortunate position there.
And basically, shout out to all of our moms. No matter how old you get, Santa Mom is great for getting those things that men don't particularly like to shop for themselves.
Once a mom, always a mom, and
Yeah.
yeah, I'm with you. I'm not I'm not a big shopper to begin with, but
No.
also buying socks and underwear. She
Yeah.
picks out great stuff, and I love it, and I wear it happily. And she actually buys the expensive brand too, stuff
Yeah.
that
So
I wouldn't pay the money for.
yeah, shout out to all the Santa moms out there. We definitely appreciate you. Um.
Definitely.
So sort of getting off topic there, but just going back to REITs. Other than RioCan, are there any other REITs that you're real that you're really in love with or are on your watch list or anything
Yeah.
that you want to just mention before we move on from REITs?
Sure, sure. Whether I'm in love with them or not at any particular time, it can depend on whether they've recently cut their distribution or what have you. But I'm pretty sizable share of Smart SRU.UN, so Smart Centers Real Estate. I think that's what they're called.
Yep, that's what they're called. Yep,
So I've got a pretty sizable position with them. I've got Canadian Apartment as well for the rental side.
yeah, that's CAR. They've been on my watch list a long time. I've never purchased. I still don't have any of that smart
Yeah,
rental, smart retail one.
so I've got that.
They've been on my watch list a long time as well.
I've got a lot of REITs. I'm a little bit, like I say, scattered here, but choice properties. I've got sizable. The Canadian Tire CT Real Estate Investment. Their main anchor is Canadian Tire.
Yep.
So we've got a pretty sizable position there, about give or take 300, give or take.
Hmm.
So I'm in with them and North. I think it's Northwest Healthcare. I think you were talking about it on your show, on your podcast yesterday.
Yeah, we were with JR. We were he had mentioned an American medical REIT and I brought up Northwest Healthcare. So I again I'm not sure how many of those I have, but I own that one as well.
Yeah, I also own, and this is the only stock. It's not a REIT, but it's related to the medical field. The only stock I've ever bought based on a tip, I guess, if you want to call that, from a close friend who said, "You've got to buy this stock. You got to buy this stock." And I don't normally do that, but I did. We all have done crazy things in the investing in our investing lives. I bought Doctor To, so Dr.to. It's I think it's called Medical Facilities or something like that. They've got medical properties, I think largely in the U.S. Don't quote me on that. Anyhow, I bought it, and they almost not immediately, but soon thereafter, in half or whatever the case was, cut their distribution or dividend, I should
Ooh,
say, in half, and the stock tanked. I bought it in the teens, and it went down to as low as, I don't know, $2 or $3. It was brutal. I wasn't selling because I thought that loss is just too big,
yeah.
and for the number of shares I own. And anyways, it's clawed its way back. I checked, I think yesterday or today, it was upwards of $11. So it's climbing its way back. And I can tell you, once I get close to or break even on this stock, I'm dumping it. I've just had enough with it, and I'll reinvest it in the other stocks, Fortis or Telus or Enbridge. I'm
So even though they cut their dividend, have you still been getting it like a somewhat decent dividend since you've taken
uh,
that hit?
it's gone back up. They cut it by about 50%, and now it's almost, not exactly. I think it's a penny off of where it was before they made that cut. So the dividend's almost been returned to at least the level it was pre-cut. So that's a positive.
Right.
But this stock, again, it was one of those hot tips,
Yeah.
and
Don't do those.
don't do those. And like, look, lesson learned. We all need to learn lessons, and sometimes you learn the hard way. Look, it's not
Yep.
the worst stock. It's not penny. It hasn't been delisted. It could have turned out a heck of a lot worse. So it's not horrible, but yeah, don't listen to your friends or your cousins or your uncle's hot stock tip.
I think it was it INO. I think that just cut recently as well, and I have that one that it's a similar position where they cut their dividend. Then of course, there's a huge sell off, so the price uh, declines greatly. But I don't have a large enough position in it to try to like recoup. It's like I'm not going to sell a few hundred, like whatever, 50 or 100 shares to and lose that 50 or 100 bucks or whatever the math turns out to be, right? I'm just going to hold it for the long term and hopefully that the dividend does creep back up to where it has been in the past.
Yeah, I've been lucky so far with Dr. T on the sense that it's almost
Mhm.
back to where it was, and the stock has returned to not the level I purchased it at in terms of the average price, but it's getting close. So
Yeah.
I will dump it at some point.
Do you have any lesser known REITs? I have a few lesser known ones that don't get talked about. Like I have TNT, I have APR, which is automotive properties. I have PRV, which is pro real estate. Um, just lesser known ones that don't get like mentioned on Twitter or in other YouTube videos the way RioCan does. RioCan seems to get mentioned everywhere among Canadian investors, but these other REITs that I just mentioned, they
Yeah,
just
I
don't get
don't.
the love, right?
No, they don't. I don't know anything about them. I don't own them myself. But some of the other ones, I guess, that don't get a lot of love, and I've got smaller positions in them. Ask me why. I don't know, frankly, anymore. Anyways, but I may be mispronouncing this one. PMZ.UN. So Primarius or Primaris REIT. There was a case for why I bought that, but why I could not tell you anymore. Um, but so be it. That one, I'm just scanning through my list. I've got here a first asset Canadian REIT, so RIT. Got a small position in as well, and Artist REIT, so AX.UN, a small position in as well.
Yeah, I've had artists on my watch list. I'm not even sure if it's still on my watch list or not. I- I've had a bad habit of in the past of like, oh, just add that to the watch list, and then all of a sudden you have 250 on your watch list, and you're like, I got to go and clean that up, and sort of like things I'm not even really looking at anymore, delete from the watch list. I'm sure you've probably been there as well.
Yeah, I've been guilty of again, I think trying to do too much and spread my love a little too thin.
Yep.
And part of my portfolio, it's a bit schizophrenic, I think, and I think that's also, and just to, if I can think back to your program, your podcast last night, and your guest there, you had a bit of a conversation about it. He's a young investor, so he has access to all the Google and YouTube and the internet and stuff like this that we just simply did not have access to when you and I were starting our investor journeys. But the I think that's why, in part, why my portfolio. I always say it's an amalgamation of different things and technologies that were available at the time. So, like I said, I started investing in index funds. That was it. Then, when I moved, when the robo, I may be missing my timeline here a little bit, but when the robo investors like Wealthsimple came out, I thought, oh, that's cool. So I did that, and they were investing in a whole bunch of ETFs, and that was cool. And then when I started to explore via a traditional brokerage purchase of, stable sort of blue chip dividend paying Canadian stocks primarily. I did that as well. So I've been grafting on or layering on different options or technologies and stocks that were available and in terms of the way you could purchase them. And
Yeah.
so fast forward, I've got a portfolio that even I think is a bit of a mishmash of overlapping ETFs and what have you. So I slowly, one of my goals of 2021 or 2022, excuse me, we're in right now. I have not been entirely successful in this. So I'm trying and I find it hard to sell things, if I'm being completely honest. But one of
Yeah.
my goals is to pare it down, eliminate or reduce at least overlapping ETFs, because I just have so many ETFs that are just simply duplicates. Because There are functions of products I bought into at different times, or brokerages I was a part of at different times. So I'm slowly paring that down and trying to tighten up my portfolio. I think it's going to decrease my diversification, which we all know is diversification is ideal, but I think I'm too diversified.
Right. So
So I'm
you would describe your portfolio as a Frankenstein of sorts.
a little bit, yes, if I'm being completely honest, and that's partly me as an investor, but wanting to play a role in everything all at once.
Yeah.
But
Mhm.
also just the fact that I've been investing in a period of time, I think, and maybe people will argue, say, well, Chris, I've been investing during that same period and my portfolio doesn't look like that. And they've got a valid point. But this period in particularly, when I started investing, it was largely, fax in forms, talk on the phone, mail it in by hard copy letter. And very quickly, it changed to a you can email it in, then you can do it online and not have to email it in, but do it right online to the world we're currently in right now. There's been a pretty quick change in the last 20 years of
Yeah.
all of
So
that.
you mentioned Wealth Simple, which basically now you just, 2 clicks, you transfer a few $100 or $1,000 or whatever from your bank account. It's hits your Wealth Simple account instantly. You click a few more buttons and you've bought 10 or 20 or 100 shares of whatever company you want. And that's all literally within, well, less than 5 minutes. I do that sort of on my paydays at work. I'm like, okay, transfer some money over to Wealth Simple, buy a few more shares of RioCan, buy some shares of EIT, buy some shares of Pizza, buy some shares of this or that, whatever I can afford, whatever I. And again, this is sort of me going back to I'm looking at the shares I have, and I'm like, what can I dollar cost average down on this week?
Yeah, yeah, I hear you. It's made it much simpler for anybody now. There's really no excuse anymore not to invest in.
100%, like literally less than 5 minutes of my time on any given day to do that, right? Like I don't know exactly how many minutes, but yeah, 5 minutes.
Well, it's a fraction of what it used to be. I want to ask you
Yeah.
though, David, again about Pizza. What's your thoughts there? I've eaten their pizza. I don't eat it anymore. I think it tastes like cardboard. In big cities, at least in Ontario, you can get excellent pizza that isn't pizza. I like the sort of Italian thin crust that you can get at these independent mom and pop type places. Got much better pizza. They don't have the scale, obviously, that Pizza does in terms of delivery. But I don't invest in Pizza because I don't simply believe in their product. I'm curious what you think.
Okay, so we'll skip to our next sector, which I have on my list, which is food. So yeah, I do own Pizza. I own um, Rogers Sugar, and I own SRV. Is it SRV or yeah, SRV? Which SRV is sort of a they own chain restaurants like Jack Astor's and a bunch of others, and they
Okay.
pay a nice dividend monthly. RSI, Roger Sugar, pays a nice quarterly dividend, fairly strong yield. Pizza pays a very, very nice monthly dividend, pretty good yield. It's not like a scary high yield, but it's a nice yield where you're like, okay, I'm very comfortable with that. So as a business, I like Pizza, but I'm kind of with you is it's not my first choice of pizza to order.
Yeah, I'm with you. So I found it hard. I've seen the case made for Pizza at different periods or stages of my investing career, if you want to call it that. And I just fundamentally don't believe in the products. I never pulled the plug in investing because I just don't believe in it. But I think their market share has been somewhat diluted, at least in the big city. I don't know that to be true, but I believe it is. Just because there's just so many options that if I think
Right.
back when I was a kid and we'd order pizza because we had the 967, 1111, call pizza.
Yeah.
And so we all ordered from Pizza. They were, I think, the dominant player, at least appeared to be, anyways. But now with the options for delivery on Uber Eats and other platforms, those one-off restaurants that have excellent pizza can now deliver, at least in major cities. And so I don't, why would I ever order pizza again? Because it tastes like cardboard. It's garbage. My opinion.
Yep. Fair enough. Like I said, I like it as a business. People do still eat it and order it. It is convenient. Um, so sticking with the food sector, any other food stocks that
You know, I
you?
just sold a food stock. I used to own Saputo, the
Yep.
cheese, I guess, dairy, whatever they are
Yeah,
into.
dairy company.
Yeah, and look, I still sometimes like I usually buy the no name brand equivalent. I'm sure Saputo probably makes it anyways, and just has it labeled differently. But
Yep.
I find the products are great. I have no qualms with that. But I sold it recently because again trying to streamline my portfolio. Maybe you should, the I'm always struggling with the internal fight between diversification. It's a sector that I'm not strong in. I don't have a lot of food. If any, Saputo was probably the only one. I think if you don't want to include couche-tard, which is obviously gas and convenience store type stuff,
Right.
which I don't really include as food per se. I don't really own anything else beyond like the large conglomerates in the US that own hundreds of products, and they own like they sort of own a ton.
Have
I
something
probably
in there
own.
that's food related. Yeah.
Oh, absolutely, and one of those large companies. So I do have some exposure, and of course in ETFs I would have exposure as well. But directly in terms of stocks, I'm thinking right now I don't own any direct food. I sold Saputo recently
Okay. Fair
for a
enough.
small profit and just reinvested that money into other stock.
So the reason I like food stocks personally, well, one, I work in the food industry. I work at a food manufacturing plant. I do purchasing and logistics at that plant. Um, but the point is, everybody on the planet has to eat every single day. So food stocks tend to be, to me, like pretty good, pretty safe because everybody's eating every day.
Yeah, you've got a point there. It's you don't eat, you die. So I would agree. But for whatever reason, uh, I I haven't been in terms of direct stock picks beyond putting aside the ETFs. I have not, and they're not food specific ETFs. They're just sort of global ETFs that are going to swallow some of that market share, anyways. I
Yep.
haven't directly invested in food. It just when I think of particularly as a Canadian, when I think of sectors to invest in that have wide moats around them, like they're oligopolies more or less, and therefore have stable, growing dividends, it tends to be the financial sector in Canada, the utilities, energy, telecoms, all
So
are
the
pretty
literally those are the next three sectors on my list. There are energy, bank slash financial, and telecom. So any of those that you want to jump into?
Sure. I invest in all of them and I'm a happy investor in all of them and I keep adding to my positions in them. So, I'm sure you and I, Dave, probably have similar positions in the telecoms, heavy in BC and TELUS, although I do have a small fraction of Rogers. And in the sort of energy, it's Suncor and Enbridge and Pembina pipelines
Yep.
there. And in the financial sector, I'm a big believer, particularly in Canada. You've got these pretty highly regulated, protected, quasi oligopoly type sectors that are very hard for anyone to break into legally or otherwise.
Right.
And so they're very protected. Now, we can argue whether that's good for consumers or not, but I think it's absolutely good for investors. Anytime you can find a market that is heavily, heavily guarded, it's got a huge iron gate around it, you can't scale. You want to invest there. So I invest in all the banks. We can argue about which bank is better than which. But look, as far as I'm concerned,
I won't
um,
argue that. I always say you can never go wrong with investing in a Canadian bank.
absolutely. I don't exercise this, but a part of me, not even a part of me, I believe, frankly, I think I could put my whole portfolio in the Canadian banking sector, which obviously would not be advisable from a diversification point of view, but I think I could. And I could sleep probably fairly comfortable at night if I did it, and probably
Yep.
earn, not probably, I would earn a better dividend outcome on an annual basis if I put all my money in Canadian banks. Again, I'm not advising this. None of this is a financial
Yep. We're
advice.
not financial advisors. We're just We're just
just
talking about
chatting.
we're just
But
chatting.
just the nature of the Canadian financial sector, it's a pretty safe bet. Probably one of the safest bets for investors in Canada, if not globally, in my opinion.
Yeah, I would definitely agree. And again, like you said, from a consumer standpoint, when you see, oh, I the bank fee for this and the monthly fee for that, and I was literally thinking this morning when I was having my coffee, maybe it was yesterday morning over coffee. I'm like, I honestly wouldn't be surprised to see just a bank fee. Here's a fee because we had to add up all of your bank fees. And I feel bad saying that, especially if some bankers watching this and it's like, hey, that's a great idea, right? So from a
Yeah,
consumer standpoint, it's horrible. But from an investor standpoint, it's like, wow, they just find ways to make money hand over fist.
yeah. As a personal consumer, I don't bank with any of the big five banks. But as an investor, I definitely invest in all of them. So I'm a happy
Yeah,
investor and happy consumer because I don't bank with any of the big five. Actually, I kind of do now because Simply used to be PC Financial is now owned by CIBC or subsidiary of. So I
right.
kind of indirectly bank with a big bank, but I don't pay any fees, the traditional checking or banking fees that you would pay with a regular large bank account.
Right. Yeah. Royal Bank soaks me every month. Actually, not that bad. Actually, I have my monthly fee, but then there's a monthly rebate. So it kind of cuts that rebate cuts my monthly fee in half. So it's kind of like, okay, well, and obviously for that fee, you do get a lot out of it. But yeah, I probably should be looking at something that has no fees, like a credit union or whatever. But that's
Yeah, I
that's
don't know
another
why
story.
people don't personally, teach their own. But for me, I don't use a bank a lot. For my personal banking, it's, I get my employment deposits a digital the check or whatever it is nowadays, money
Hmm.
into my bank twice a month, and I send the occasional email money transfer. I rarely go to a bank anymore to withdraw cash. Some places I go to for entertainment or whatever require cash. It's rare, particularly nowadays. So I almost never use a bank machine. But when I do, it's as long as I'm using the CIBC one through Simply Financial, it's free. There's no
Right.
charge. I don't
Yep.
know why people don't bank, do their day-to-day banking with one of those no fee type banking arrangements. I just don't know why, because they're so convenient and they're good.
Yeah, I probably should be doing that too. It's just I've been with Royal Bank since I was like 3 years old, so it's. Anyways,
Yeah.
moving on from the financial sector, we briefly touched on energy and telecoms as well. Um, Energy, actually, the only one I have right now is Suncor. I think I talked about it last night when I was uh, talking with JR, or maybe it was a tweet I had sent a week or so ago saying I happened to get into it when it was my dollar cost average was around $33. I sold someone it last was that about 6 months ago? There maybe less that spiked up to 50 over $50. I'm like, oh, now's probably a good time to sell some of those, and um, but I held enough to keep that dividend coming as well. So, not saying I timed the market. I'm saying I lucked out.
Yeah, I can see looking at my portfolio, I bought quite low. I don't have the figure in front of me. I'm looking at my Wealthica account, so I don't have it quite in front of me what I paid on an average basis, but I can see in terms I bought low for sure or lower, so I've done quite well on
Yep,
that stock.
and I can see. Obviously Suncor retreated from that 50, I'm pretty sure it was a 52-week high around 50 or 51, right where I again, I'm not saying I timed the market. I'm saying I lucked out and sold right then. Um, and I didn't sell a whole lot. I just sold a few and then obviously put that right back into something else that was paying me a dividend. So
Yeah,
it's
myself, I put a whack of money, again, not timing it, but just taking advantage of the opportunity presented in March of 2020, February, March, COVID.
yep,
Uh, the market, as we recall, tanked quite considerably. And so I deployed a whack of money. at that point. I was lucky to be in a fortunate position where I had some surplus cash. Again, I'm always investing, so it's on paper I look broke
Yep.
because I'm always investing my money, but I happen to have a whack of cash that I could deploy, and I deployed a ton and bought these solid companies with healthy dividends that have been, in some instances like Fortis that have been paying them for close to 50 years now, pretty reliable. And the banks, of course, some of them have been paying them since the 1800s. I deployed a whack of cash at very low cost in terms of the true intrinsic value of these companies and shares.
Yeah, that's what you said there is key is I look broke or I on paper I am broke. That's perfect, right? Like,
Yeah, there's something to be said, I think, for to borrow the phrase from the book, The Millionaire Next Door. I am the multi-millionaire next door that nobody knows about. When you see me, if you were my neighbor, Dave, look, I'm a nice guy, I think, but you wouldn't necessarily know, judging by my appearance. I'm not unkept, but I'm also not walking around with flashy labels
yeah,
on my clothes. You won't see any labels, frankly. You might see an odd one on a shoe, but
yeah,
beyond that, I'm not a flashy guy, and I ride my bicycle, and I don't own a car. I happen to live in an urban center where that's easy, but I
right.
keep my lifestyle in check. But at the same time, my mom, she asked me too, why don't you buy something? Buy something, buy something. You can afford it, buy something. And I
Yeah,
tell her, I
buy
said,
that Lambo. Buy a Lambo.
yeah, yeah. Look, hey, if my crypto portfolio took off the way it was supposed to, my small, less than a couple percentage portfolio of my overall size of my portfolio investment in crypto, if it had taken off, maybe there'd be a Lambo, but
Yeah.
if it went to the moon, but it didn't. And
When
that's
Lambo. When yeah, when moon, when Lambo.
you know what? Even if it had, Dave, I wouldn't have bought the damn Lambo because what I did recently is I had a beater of a bicycle for a couple of years and it wasn't great. And like I'm not a spring chicken either, so riding bikes, gets a little bit tougher as you get a little bit into middle age. So I bought myself. I don't know if this bike is 600, $700. It's not outrageously expensive. You can spend a heck of a lot more on
Oh
a
yeah, you can spend
bicycle.
$10,000 on a mountain
Sure,
bike.
sure. Well, I didn't, but I did buy a new bike, and I love it, and I'm happy with it. And that bike, I can tell you, kind of like Mr. Money Mustache for people that follow him, gives me untold amounts of joy I derive from that bicycle. So if you amortize this bike, even if I paid 600 or 700 bucks or whatever it was, amortize that over the life of the bicycle. Hopefully, I get 5 years, let's say, out of this thing. The
Yeah.
cost is next to nothing for the joy it personally brings me in terms of a
Well, and not
motive.
just to mention the joy, the health benefits of riding a
Sure,
bicycle, the fact that you're not paying for gasoline, the fact that you're not paying for car insurance. Like, yeah, you're winning on a lot more than one level by riding a bike.
absolutely.
And being in an urban center, like I live in a very rural area, so a vehicle is pretty much a necessity. But if you can do that in in an urban setting and ride a bike and not have a car, not pay for gas, not pay for insurance, not have a car payment, like winning, 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 right?
Yeah, I've been fortunate enough to always live in a variety of different urban centers, be it in North America, and I've never had to own a car in my life. So
Wow.
I know how to drive. I've got my
Yeah.
license, and I use the car shares and ride shares and the bike shares and what have you.
Yeah, and you can
But
rent a car if you need to, or rent a
sure,
U-Haul if you're moving or whatever,
yeah,
right?
done all of that. And so I do drive occasionally, but you're right. It's a win-win-win because I'm avoiding, and I also don't have children. So that's another factor that makes it tougher, even in urban environments sometimes to not have a car if you've got kids to move around. It's
Right. Taking kids
challenging on
to
public
soccer
transit.
practice, hockey practice, baseball practice, or baseball games and
Yeah, my
dance
parents.
dance recitals and everything else the kids do. It's taxing to say the least.
Yeah, I get it. My parents had at least a car when we were kids. So yeah, you need one if you've got a family. I don't myself, so it's easy for me to avoid it.
Nice. Telecoms we also touched on briefly. You mentioned BCE, Bell Canada, and TELUS.
Yeah,
I've actually just recently started a very small position in Bell. I have jokingly tweeted, but almost half seriously, that I'm going to buy enough shares in Bell that they pay me to buy TELUS.
Yeah, look, they're both, I think, both solid bets. I don't think you can go wrong with either one of them. Telus seems to be, at least from the dividend, the div twit community on Twitter, seems to be a fan favorite,
Yep.
uh, and that's exciting because I think they, well, Bell does too. They both have history. Bell a little bit longer, obviously, of increasing dividends and paying them out. So that's what we like to see as dividend investors. Long track record of that, and growing, frankly.
Yep.
So that's exciting. I did invest. Talking about Telus, I did invest in some of their offshoots, at least one of them, and I'd have to pull it up to be more precise of that offshoot. Give me a hot second here. That offshoot was that TELUS had their here it is. It's TIXT. It's TELUS International. I can't remember what that was, but it was an offshoot of TELUS. They're sort of starting to break out some of their units into separate stock offerings. So I did buy into that, and it's done all right to date, at least in terms of when I bought in. So
Good. Good stuff. And then basically the only other two in Canada would be Rogers and Shaw, and I guess Quebecor would be sort of the fourth or the fifth. Any thoughts on any of those three?
I don't own Quebecor, although I've looked at it. And again, I'm trying to like not buy more and stick with what I got because I do have a habit of buying everything. And the Rogers and Shaw, I do own small positions in, but Shaw could get swallowed soon. And I've actually sold some of the Shaw that I did hold. I still hold a small amount, a small amount in Rogers. Both of them are performing in terms of where I bought them at, but I don't see myself holding those much longer either. I'll probably stick with. I'll narrow myself down to Bell and Telus.
Yeah, that's I would probably do the same if I were in your position.
Yeah.
And sort of last on my list of the sectors we were going through, we've already touched on it briefly when we talked about Northwest Healthcare, but healthcare was sort of is one of the well, is the last sector on my list. So other than NWH, anything else you would like to mention or talk about?
No, I think we covered it because I mentioned the Dr. TO
Yep.
medical facilities stock that I own too much of, based on the hot tip from my friend, which was not so hot in the end. But no, beyond those, no. I guess maybe the more broad exposure you might have through an ETF, which I don't count.
Right.
That covers, as you know, an ETF. You can cover a whole whack of stuff,
Yeah,
which is great.
sometimes you have an
Which is great.
ETF and you're not even sure what everything you're exposed to, right?
No, and I think that's part of the beauty too of ETFs, at least
Yep,
like
I agree.
a broad market ETF with global XAW is a big fan favorite. Seems to be amongst investors that are in Canada that are hybrid investors, both dividend and ETF, which I am. XAW is a popular one because it's ex Canada, because we already hold as Canadians, arguably, some would argue too much Canadian exposure. Some would argue not enough if you really focus your efforts there. There's a case to be made both ways, I think, in Canada, but I do hold XAW to get me that diversification. But beyond Dr. TO, which I'll be exiting at some point, not directly. I won't be holding directly medical stuff too much beyond a read here or there.
Okay, good stuff. Last on my list is just other. Any other um dividend stocks that you think we should touch on? Something that's definitely like sort of in your favorites or on your watch. Well, you don't have a watch list you're trying to sell off, but anything else you want to talk about?
No, I think we've done a good job of covering the sectors, particularly in Canada, and I'm sure these ones that we talked about are stuff that everyone's investing in. So I think we've covered the bases there. Personally, as I talked about, I'm really trying to pare down some of the overlap and duplication I have that I've just sort of like. It's not my personal experience with my house. My house is very minimal,
Yep.
but some people will accumulate stuff in their house over time, and they sometimes need to clean house. My house that I live in is minimal, but my investment portfolio, has grown over the years and is less than minimal, at least where I want it to be, given duplication and overlap. So I'm trying to really breathe and focus and try to do some of that I find hard sometimes, which is
Right.
selling. I do find personally, just it's a challenge of mine. It's a mental block that I'm having to work through.
So my house is also very minimal. It's my garage that is the problem.
You're not alone for a lot of people.
Yeah, right. I have a lot of tools and a lot of stuff in my garage that belong in the garage, but yeah, my house is more or less minimal as well, right? Like I've got a very basic house. Obviously, I've got some furniture, couches, and chairs. You know, uh, beds and whatnot, and table and chairs. But other than that, it's just sort of your minimal what you need and nothing too extravagant.
Yeah, I'm the same way. I think it helps too with, and this is perhaps going a bit off topic, but it just helps with mental clarity. I can focus on things
Definitely.
that I value in my life, be it work that keeps me pretty occupied Monday to Friday, but other projects without the distraction of too much in my house.
Okay, Dividend Daddy, thank you so much for your time. Anything you want to shout out here in the last 30 or 60 seconds?
Well, thanks for having me, Dave. I appreciate it. Like I say, I think this is my first podcast. I'm pretty sure it is in terms of dividend investing. So I appreciate the opportunity. It's been a lot of fun, and I do look forward. I did catch some of the, I think was your inaugural podcast. Was it your first one yesterday? I
Yes, it
caught some
was.
of it, not the whole thing. I enjoyed the conversation, particularly from the perspective of that young investor that you had on. But the only thing I would add, if I can, is for folks that are interested in following along my journey. Could I make a plug, Dave? Is that okay?
That's what I said. Shout out whatever you want. Shout out your Twitter handle, shout out your blog, shout out anything you want to shout out.
Oh, I appreciate that. So for folks that want to follow on Twitter, my handle is at Dividend Daddy One, the number one, so Dividend Daddy and then numeral one. And for folks that want to read along on my blog, you can find me at www.dividenddaddy.ca. So those are my two plugs. Thanks, Dave. Appreciate it.
Yeah, you're welcome. I will try to link those in the descriptions below. And if you're watching on YouTube, subscribe. And if you're listening on audio, subscribe and give the podcast a thumbs up. Okay. Thanks, everyone. Catch you next time.